Welcome to Casa Academy Chapter 12, Part 3, where we will cover residential mortgages. So, when you step into the wild world of real estate, the actual financial mechanics behind buying a home are, well, they're absolutely fascinating. Because, believe it or not, when a property is bought using borrowed money, different states across the US don't actually treat ownership the same way during the life of that loan. There are literally two entirely distinct systems at play here, and getting a solid grip on them, it's absolutely fundamental to mastering real estate law.
Right, so this brings us to the core conflict of our explainer today. When you buy a property using a substantial amount of borrowed money, which is most of us, right? Who actually holds the legal ownership, the title, during those years or even decades of paying off the loan? The answer actually depends entirely on which state you happen to be standing in. And honestly, getting this right is a major key to absolutely crushing your exam.
Okay, here's our quick roadmap for the lesson. Number 1, welcome to residential mortgages. Number 2, understanding title theory. Number 3, Florida and lien theory. And finally, number 4, summary and key takeaways.
Moving into our first big topic, understanding title theory.
Let's dive right into this first major legal framework used here in the States for handling real estate loans, which is title theory. This is the system used by a lot of states, and it has a very specific way of protecting the bank or the lender who's basically handing over hundreds of thousands of dollars. Think of a title theory state as operating kind of like financing a car. If you've ever financed a car, you know that the lender actually holds the physical title to that vehicle as security until you make that very last payment. Why? Well, because if you happen to stop making payments, the lender holding that title has a much easier and faster path to recover their collateral. Title theory in real estate operates on that exact same protective logic. So let's look at the actual mechanics of how this plays out. In a title theory state, when a borrower gets a loan to buy a house, the title isn't actually held by the buyer. And surprisingly, it isn't held directly by the lender either. Instead, it's held by a third-party trustee for the benefit of the lender. At closing, the borrower signs what's known as a deed of trust. This document officially conveys the title over to that trustee. So for example, if an underwriter at a lending institution is reviewing trust file number 111248, they are relying heavily on this specific deed of trust as part of their security interest in the property. It's essentially their giant safety net. Now, the crucial point here is how this whole story ends. Because the title is held by the trustee during the loan period, the lender has a really simple process for recovering the property if the borrower defaults. But hey, what if the borrower does everything perfectly? Once the loan is finally paid off in full, the trustee executes a very specific document called a reconveyance deed, or sometimes a deed of reconveyance. This is that triumphant moment that officially transfers the actual title right back to the borrower, making them the free and clear owner. Next up, Florida and Lien Theory. And real quick, before we dive into these details, your verification code is 598770. Okay, let's keep going. Now, let's look at how the rules completely flip upside down when we cross state lines into a lien theory jurisdiction. I've got a simple, foolproof memory aid for you here. The word Florida contains the letter L for lien theory, and it absolutely does not contain a T for title theory. Literally, burn this quote into your memory. Florida is strictly a lien theory state, and that fundamentally changes the borrower's entire relationship with the property. So what does that mean? Well, in a lien theory state like Florida, title passes to the buyer immediately at closing. The borrower becomes the property owner right from day one and stays the owner throughout the entire term of the loan. But wait, you might be wondering, how on earth is the lender protected if they don't hold the title? To protect the lender, the borrower signs a mortgage that pledges the property as security for the loan. This absolutely vital process of pledging property as security without actually giving up possession of it is known as hypothecation. It's a huge word, I know, but it is an incredibly important concept to grasp. Okay, let's walk through the exact steps of what happens when things go wrong in a lien theory state. Step 1. The mortgage signed by the borrower creates a lien against the property, giving the lender a legal financial claim. Now, step 2. If the borrower defaults and just stops making payments, the lender does not automatically own the property. They can't just walk up and take it. Instead, we move to step 3. The lender has to successfully enforce its lien rights through a formal legal foreclosure process. Only if that foreclosure is completely successful can the lender ultimately obtain title to the property. Bringing us to our final section, summary and key takeaways. All right, we've covered some pretty heavy legal ground in this explainer today. So let's lock this knowledge in with a rapid-fire rundown of the key differences. On the left side, title theory. The trustee holds the title for the lender's benefit, which translates to a much easier, faster default recovery. Versus, on the right side, lien theory. Here, the borrower proudly holds the title themselves, while the lender merely holds a lien, meaning any default requires a full-blown foreclosure process. The biggest takeaway here is simply knowing who exactly holds the title while that loan is outstanding.
Let's summarize the core vocabulary words from this lesson as your final study guide. In title theory, you're looking for the words deed of trust to start the loan, and it ends with a reconveyance deed. When you think of Florida, remember the L. Florida uses lien theory. And finally, lien theory relies entirely on hypothecation, which remember is pledging that property as a security blanket for the lender. Having a solid grasp on these terms ensures you know exactly where the lender's protection comes from in each scenario.
To wrap up our explainer today, I want to leave you with a bit of a provocative question to really test your understanding of risk and recovery here. Knowing exactly how defaults are handled under both of these systems, if you were a lender handing out a $500,000 mortgage, which theory would you personally prefer to operate under when a borrower suddenly stops paying? Think critically about these legal frameworks, the speed of recovery, and who actually holds the cards. Keep that thought in mind as you continue studying, and you are going to do absolutely fantastic on your exam.